Hello, everybody. My name is Lush Eisner, and welcome to the Canadian Money Talk, the channel about Canadian investing and personal finance. Please like and subscribe. I record 2 videos per week, so make sure you ring the notification bell to get notified each time one comes out. Today is January 11th, 2023, and I had a question to analyze the Canadian real estate market in and for 2023. So let's look at the economics around real estate first. Firstly, housing and real estate doesn't lead, it follows, mostly being affected by interest rates, which is what the real estate market really depends on, because everyone is borrowing to buy real estate. For the last 2 decades, the prices of Canadian real estate have come up significantly with the low and over time decreasing interest rates. The cheap money had made the carrying costs low and allowed buyers to afford higher prices, and the sellers obliged. Canadian real estate prices have been down since the peak in February 2022, and the sales have slowed significantly. The year-over-year percentage change in real estate prices has been coming down since early 2022 as well. Carrying costs of a home, assuming a mortgage, is increased significantly by the increasing interest rates, forcing prices of the homes to come down to keep the same level of carrying costs. For example, 4% extra interest is $25,000 more in interest payments per year for average Canadian house, $35,000 in Toronto. The current house affordability in Canada is the lowest since 1981. In the major cities, we need more housing supply, or sellers will need to accept lower prices. Let's look at some numbers for November 2022. The aggregate composite MLS home price index, HPI, edged down 1.4% on a month-over-month basis in November, which, as with sales activity, continues the trend that began in the spring. The national MLS HPI now sits at 11.5% below its peak level, but there are considerable regional differences. So for November, the national home sales declined by 3.3% month over month. The actual, not seasonally adjusted monthly activity came in at 38.9% below November 2021. The number of newly listed properties edged down 1.3% month over month. The MLS home price index declined by 1.4% month over month and was down 4.4% year over year. The actual, not seasonally adjusted national average sale price posted a 12% year over year decline in November. Now, to look at a specific market, the GTA housing market ends the year with average price of a home at 1.189 million, up 8% from 2021. The Greater Toronto area is down 19% from its high in March 2022, when the Bank of Canada started raising rates. The GTA is plateauing now, with prices stabilizing. Toronto had a 50% drop in sales volume from the year before and less than 1% decline in prices from November. Now, some numbers from December 2022. In Vancouver, December sales activity dropped 50% year over year, and prices fell 1.5% from November and 3.5% from December the year before. For investors holding Canadian real estate, there is a silver lining. Rents are going up with the 500,000 immigrants coming into big cities every year. Rents are going up despite the assets going down. After pandemic-driven declines in 2020 and 2021, Canadian rental rates are on the rise again. The median rent for all property listings for the second quarter of 2022 was $1,750, a 7% increase over the same period last year. Ottawa approved more permanent residency applications than ever last year. That's not out of character. In 2020, Canada ranked 4th in the world for immigration friendliness. One reason why Canada's welcome mat is so big: Well, with nearly a million unfilled jobs, 104,000 of which were added just last month, we're going through one of the biggest labor shortages in our nation's history. So let's look at 2023. There's multiple things that are happening. First, we have new laws. So houses may be permanently unaffordable despite a law stopping foreign buyers from buying in Canada for the next 2 years, which takes effect now, with some exemptions. It is estimated that foreign buyers own only 4% of Canadian real estate anyway, so it probably won't make a big difference going forward. Let's look at inflation in 2023. The Central Bank of Canada currently projects inflation will be back at around 3% year over year by the end of 2023 and to fully return to 2% target by the end of 2024. I think this is optimistic. Once back at the target inflation, the rate hikes should stop and the real estate market stabilize. However, because interest rate hikes take from 6 to 18 months to work their way through the economy, the central bank must stop raising rates a lot sooner, allowing the real estate to stabilize sooner as well. So let's look at interest rates in 2023. Interest rate hikes are mostly done, although there will likely be a 0.25% rate hike on January 25th. That could pull some variable rate borrowers off the sidelines once it's clear to all that we're at the top for interest rates and we're not going back to the rates of the 1970s and 80s. That collective realization may also dawn just as market gets a burst of desirable new property listings in the spring. But as far as getting back to quote normal in interest rates, the bigger question for housing markets is not so much whether the top or terminal rate will be, how long it will stay there, or when rates will start coming back down. The question is, when will rates be back at lower levels? Most fundamental factors needed for the market to take off again are still out there. I do not believe the central bank will cut rates in 2023, however, unless unemployment shoots up and we get a hardcore recession when a serious slowdown, which would include slowdown in real estate transactions, fewer mortgages, and more real estate price declines, which would partially offset the lower rates anyways. Another reason I think central banks will not cut rates in 2023 is because interest rates have been in emergency lows for a decade and they're only now normalizing. Let's take a look at price movements in 2023. As long as only token rate increases happen from here and the central bank pauses to let previous rate hikes take effect, real estate in Canada may decline another 5% at the most, for roughly 20% from the peak for the most expensive cities like Vancouver and Toronto. Depending on your location, your real estate could have gone down less or possibly even appreciated a small amount in the last year and will probably stay flat for 2023. Assuming no significant rate hikes from this point, the prices will stabilize after that possible small decrease and stay flat for 2023 and beyond. After the big 2-decade run-up in real estate prices due to the low interest rates and cheap money, there will need to be a return back to the long-run average appreciation of real estate, which is roughly 3% or the rate of inflation. Sales volumes will be low and the industry lethargic, as investors can't count on the appreciation of the asset anymore, and the disheartened sellers pull their houses off the market when they think they can't get the price they deserve. How will this affect Canadians? For many first-time homebuyers, passing the stress test with a 7% interest rate may require them to wait, not just until rates have possibly started to decline, but until they've declined quite a bit. That's more likely to be a 2024 and a 2025 story than a 2023 one. For residents of the real estate, they are getting a discount on the price, but paying more in the mortgage, so they may be in the same place as a year ago when the higher carrying costs are included. For investors in 2023, depending on how much of a down payment they have, they may be better off if they are putting in a big down payment. But then they still have an opportunity cost for not being able to use anything beyond the required 20% down payment elsewhere. Real estate's main money-making machine is the leverage achieved by borrowing. Since it has been a very difficult for an investment property in Canada to have positive cash flow with 20% down payment, the higher rates and higher mortgage payments will continue to make cash flowing a property impossible. For renters in 2023, things have gotten worse previously and may continue to get worse because of the rent hikes. The Canada Mortgage and Housing Corporation defines, quote, affordable housing as shelter costs that are less than 30% of a household's before tax income. Taking into account rent and utilities, here are the calculations of how much a household has to earn to keep the average cost of a two-bedroom apartment below that threshold. In Vancouver, where the average monthly rent of a two-bedroom apartment has reached an astounding $3,597, a household would have to earn a gross income above $150,000 in order for that rent to be deemed affordable. In Toronto, a household has to make more than $135,000. So that concludes my thoughts on Canadian real estate in 2023. It may go down a little bit more perhaps and then stabilize. If you have any requests on what you would like me to cover in future videos, please put that into the comment section. Please like, subscribe, ring the notification bell, and may you have a profitable day.